We have a new edition of Commodities Confidential, the show that features analysts from CPM Group, the leading New York-based research firm. Joining me today is Rohit Savant. He's their senior commodity analyst, and we'll be talking about gold. It's the first Commodities Confidential of 2013. Joining me now from New York is Rohit Savant. Rohit, Happy New Year. Nice to see you.
Happy New Year to you as well, Daniela, and thank you for having me.
So Rohit, when we last spoke back in November in San Francisco, you mentioned that you expected gold prices to soften at the start of the year. That's exactly what has happened. We've also seen other firms such as Deutsche Bank, UBS, Credit Suisse, all revise their gold forecasts downward. My question to you today, Rohit, is now as we start this new year, how does CPM see gold prices positioned?
Our view on gold is still pretty much the same that we had at the end of last year, which is that we expect gold prices to soften somewhat this year in relation to where they were last year. We actually have a gold price average of about $1,650 for 2013, which is about 1.5% lower than the average for last year. So our view, we still stand by our view that we had in the last quarter of 2012.
Rohit, so gold has tended to respond well in an environment of low interest rates, currency market volatility, high inflation, and a weak stock market. What situation do you think could hurt gold this year and or benefit it?
But first off, yes, gold does respond well to interest rates and currency market volatility, but there have been times when gold prices have not necessarily responded the way markets expect them to. And that, for example, in the case of interest rates, typically negative real interest rates would result in higher gold prices, but that's not always the case. Similarly, with currency market volatility, you've seen gold prices both move higher when there's increased volatility and even lower sometimes when you've seen increased currency market volatility. So there is that relation between these metrics and gold prices, but that's not always the case. What we think would hurt gold prices this year would be the price of the metal. What we think is that investors are becoming, or have been actually, fairly price sensitive, and so are unlikely to step in as buyers at high price levels. Instead, we think that they probably wait for them to soften before they step in as buyers. For example, in the first week of this year, we saw gold prices come off, and we didn't really see a positive response coming in from ETFs or American Eagle coin sales. The premiums on those coin sales were actually down in the first week of the year. The net additions to gold ETF holdings was down compared to where it was at the end of 2012. So looking at those factors, what we think is that investors would probably want to see gold prices decline further before they actually step in as buyers. So what we think would hurt gold this year would be the price of the metal itself.
But Rohit, what would make this year different than last when we saw gold start off the year at $1,900 an ounce?
A lot of, I guess, what's been happening over the past several months now is that investors are backing away from this constant fear that's being fed into the market about how the global economy would collapse and how the financial markets would collapse. And that's been something that's been in the market now for a couple of years, which really was driving investors towards gold. You saw that most strongly in 2011, to some extent in the early parts of 2012. But I guess over time, investors have realized that that's unlikely to happen. A lot of these problems do exist, of course, but they're structural issues which would take a long time to be resolved, and there's no real expectation among investors anymore of this so-called collapse in the financial markets. So I guess what investors are now responding to is that, okay, they see these as problems, and so as long gold would be a good investment in the long term, but there's no reason for them to rush into it and buy it at these at high prices or in a rising price environment.
So Rohit, I guess that leads to my next question. Would you label this, would you categorize this as investor disinterest?
I wouldn't say we're seeing a disinterest, but we are seeing increased price sensitivity. So investors are still interested in buying gold, but they are not interested in doing it at high prices. So if you probably see prices stabilizing at 1600 or 1550, you might see a large influx of investor demand at those price levels.
But what about the debt ceiling issue, Rohit? Don't investors still want to protect themselves?
Yeah, the debt ceiling, like many of the other issues that the global economy is faced with, is one of those longer term structural problems in especially the developed economies. And so yeah, that's the reason why I say investors are still interested in gold, but they're not as fearful of the debt ceiling or any of these other issues as they had been, say, in 2012 or 2011. The debt ceiling this time around, I guess, for the same reasons that investors have been backing away from buying gold in a rising price environment, what you're probably going to see is the debt ceiling talk would be supportive of gold prices, but unlikely to push gold prices up sharply the way it did in 2011.
And if we look outside Washington, how are China and India demand playing a role in the gold price?
Again, fabrication demand from both those countries is important and is supportive for gold prices. Investment demand, of course, is the most important factor that influences gold prices. In the case of China and India, you're likely to see continued demand from both those countries in 2013. In the case of China, especially over the next couple of weeks, you probably see a sharp increase in demand ahead of the Lunar New Year. So yeah, demand from both those countries we expect would remain healthy and be supportive of gold prices.
And finally, Rohit, just a quick note on silver. Is it taking a cue from gold?
Yeah, I mean, silver to a great extent tends to shadow gold prices. Again, we expect price sensitivity on the part of investors as far as silver is concerned. Declines in prices, we think, would drive investors towards silver and basically be supportive. So both in the case of gold and silver, what we are expecting in 2013 is no sharp increases or declines in prices. If you see a decline in prices, you're probably going to see a lot of investor interest. If you see increase in prices, you probably see, in the case of silver, maybe selling of silver, and in the case of gold, investors probably backing off from making fresh purchases.
Okay, finally, Rohit, just to recap one last time, your price range from gold if we're looking at a 6-month window.
In the first 6 months, we probably see gold prices softening. On the whole year, we have it averaging at about $16.50. And then in the case of silver, we have it averaging around $29 to $30.
Thanks so much for your time, Rohit. And from what I understand, CPM just put out a 10-year outlook on the platinum group metals. If someone would like a copy or would like more information, how can they go about it?
I guess the best way to get in touch with us would be through info@cpmgroup.com or pgms@cpmgroup.com. And the person to ask for would be Matt Daw.
Thanks, Rohit, and thank you for watching this edition of Commodities Confidential. We'll be back next week. In the meantime, you can email me any comments or questions at newsfeedback@kitco.com or tweet me at Daniela Cambone. Thanks for watching.